Okay, look, I think we're going to get going. Hello, everyone. My name is Giles Parkinson. I'm the editor of Renew Economy and its associated websites, the EV Focus, The Driven, and One Step Off the Grid. And welcome to this webinar, How to Make Money Out of Battery Storage. And it's sponsored by Energy Storage Australia, who are holding a two-day conference in Sydney in May. So I think you'll find some details on the registration form that you clicked on for more details about that conference. Look, we've got a great bunch of guests today. Two very senior executives from two of the leading battery storage developers in Australia, and an expert on the global uh, climate and energy scene. So we're going to be joined by Paul Curnow from Acacia Energy, Daniel Burrows, the CEO of Acacia Energy, and Tim Buckley from Climate and Energy Finance. We're going to start off with some conversations, first with Paul and then with Daniel, just about what they're doing now, the batteries that they're in the process of installing or have installed, how they're making those work economically and financially, and their sort of projects in the pipeline, and how they see the industry developing. We're also going to get a short presentation from Tim, and he's going to be focusing mostly on the international scene and some of the other things sort of driving the whole sort of shift to storage and renewables. And I imagine particularly is going to be focused on some of the cost reductions that are being seen around the world and some of the supply chain issues as well. Look, battery storage, big battery storage has probably been the success story of the Australian energy transition in the last year, apart, of course, from rooftop solar and the increasing shift to domestic battery storage and heat pumps and things like that for the large scale scene. We've had lots of promises about wind and solar, but not so much actually sort of reaching financial investment and getting built. Some, of course, but not quite enough yet to get to the 82% renewable energy target, which the Labor government has now locked itself into, based around the AEMO integrated system plan. Battery storage, though, is going gangbusters. According to the latest data that I've seen from the Clean Energy Council, there are 27 utility scale batteries under construction at the end of 2023. That's equivalent to 5 gigawatts and 11 gigawatt hours of combined capacity. $5 billion of new investment commitments in battery storage in 2023. And it's hard to remember sometimes, but it was only 6 years ago that we actually saw the first very big battery built in Australia, the Tesla big battery at Hornsdale, built in 100 days following a series of tweets by Elon Musk and Mike Cannon-Brookes, which shows what you can do when you get some good tweets from some good billionaires. But since then, the battery storage industry is now sort of rapidly expanding. So it's going to be interesting to see what we hear today. Look, we are going to have these three chats and presentations. That'll take the first half of the session. Then we're going to open it up to discussion, and we would really like your questions. If you do have a question, please put it in the Q&A. We've got a chat box there as well, which you can free to chat, of course. But if you really want a question to be answered by one of our panelists, then please put it in the Q&A. And usually we get lots of them, and we kind of pick out the most interesting ones and see how we go. And we'll also probably run a survey question. So if anyone's got any suggestions for some survey questions that they'd like answered, please offer them. If not, we'll put one or two up as the meeting goes. So look, the first person I'd like to introduce you to is Paul Curnow from Acacia Energy. Paul, thanks for joining this webinar.
Thanks, Charles. Good to be back.
Look, you guys, you're building your first battery in Australia, and it just happens to be the biggest, the Waratah Super Battery, which is a very grand name. It's 850 megawatts. It's 1,680 megawatt hours. So it's just over, roughly 2 hours storage. It's playing a very specific role in the grid as kind of the shock absorber. Basically, and this is one of the things I'd like to sort of tease out from this discussion is all the different things that batteries can do. But look, can you just give us a quick introduction about who Acacia Energy is, who's backing it, why you're here, and what you're doing?
Yeah, thanks, Charles. Maybe just before we start, just like to acknowledge the traditional owners on the land I'm sitting here today in Melbourne, the Wurundjeri people, and pay my respects to their elders past, present, and emerging. So look, Acacia, we're a developer, builder and operator of large-scale grid-connected batteries. So that the whole business has been built around the thesis, and your opening remarks confirm this, Giles, in terms of the massive need for storage as electricity systems decarbonise. So the business was set up in mid-2021. Nick Carter, Andrew Wegman, and Tony Full, the other managing directors, started Acacia in that period. And as you say, we've sort of grown pretty quickly from there on the back of winning the Waratah tender in the middle of, when was that, October 22. I have to keep reminding myself of the dates these days. So our whole approach is really large-scale grid-connected batteries as really that key enabler for high levels of renewables in energy markets. To date, we've been focused on building out our pipeline in Australia. So we've got over 10 gigawatt hours in the pipeline at various stages of development, about just over 4 gigawatt hours under construction, which includes the Waratah super battery. Happy to talk about that in a minute. Other projects, we've got a couple in Queensland, Ulinda Park and Brendale, and people might have seen that we were also successful last year with one of the New South Wales long-term energy service agreements, the LTESs, for our 400 megawatt battery in New South Wales, just near or inside the RES, New South Wales Central West Arana RES. And so I guess our whole thesis is really about innovative design around batteries and rapid deployment. And that was sort of one of the key attractions in terms of partnering up with BlackRock. As you mentioned, sort of who's behind us. We're one of the portfolio companies of a BlackRock managed fund, and that's obviously allowed us to tap into significant pools of capital. And for us, really, really important pools of capital, namely institutional investors who take a long-term view on these assets. And so, as I mentioned, apart from being a developer, all our projects were greenfield originated. We are long-term asset owners, and we really look at then the value chain of batteries, and in particular, as we'll talk about, no doubt, through this webinar, how do you actually operate batteries to make money in different markets. In Australia, of course, the wholesale market lends itself quite well to the balance of exposure to merchant prices, but with contracted revenue from different types of off-takers, which we can dive into as we discuss. When we look at other markets that we're focused on, including Japan and some markets in the US, you get different markets, whether they're true wholesale markets or more vertically integrated markets, where the type of services of batteries and the way in which you monetize those are quite different. So it really is a lot of analysis that's required to work out how do you design the battery, what type of battery you need, what type of services it's really going to capitalize as far as revenue streams across those different markets that we're looking at.
Well, look, let's start off with the Waratah super battery. You guys announced just last week, I think, or someone announced, the Energy Co, the people responsible for the sort of the transmission requirements, that you've relented your GPS performance standards, which is a very important thing and something that not every project in Australia has been able to get in good time. And obviously there's a sort of a pressure on you guys to actually sort of deliver on time, because, the closure of Eraring may depend on it, although we're yet to see what happens there. So look, just tell us about how, it's acting as a shock absorber. So basically this is part of the Swiss Army knife offerings of a battery. In this case, it's basically grid support, allowing transmission lines to be operated at bigger capacity or even full capacity. So tell us exactly what it's doing and how you're getting paid for it. What makes this battery work?
Yeah, so it's an interesting structure. So it's combining sort of two revenue streams, and I guess that was sort of behind our design of that battery and bidding it in, which was obviously it had to provide the SIPS service, the System Integrity Protection Scheme service, as mandated by the terms of the Energy Co and for Transgrid as a system operator. And that obviously goes to your point, Giles, in terms of being able to respond in a matter of seconds to provide that system strength and support within the Sydney ring, to the extent there are failures on the transmission lines elsewhere in the network. And particularly it's about bringing in all of that New South Wales renewables resource from those reses, which of course are not next door to Sydney, but further upstate or out west. And so the way the battery would operate, it can deliver up to 700 megawatts in a matter of seconds in terms of that SIP support, to the extent that there's a fault on one of the transmission lines. And so what that means is you creating effectively virtual transmission, because the battery allows, as you said, the network operator to run the existing transmission lines at full capacity. In an N1 redundancy case, you can rely on the battery to fill that. The flip side of the battery is, of course, a decrease in generation in the res, and that's part of the program that EnergyCo is running in terms of procuring that from different providers across reses. On top of that, we've built the system. We actually built at 850 megawatts, as you said. So the SIP service is 700 megs. So we have 150 megs that we can operate within the merchant market, and that allows, I guess, that delivers a number of benefits. One is that we were able to bid in a competitive price because we've got that merchant exposure, which, and we'll talk about this later, in terms of giving us the upside in terms of the merchant revenues. But it also meant that oversizing it, we could deliver or meet the risk allocation within the SIPS contract, because there's quite, as you'd expect, quite strict requirements to be able to deliver that SIPS service within a matter of seconds.
That's interesting there. So that's an insurance product for you, but it also gives you an added market sort of revenue potential. Yeah.
Correct. Yeah. So that's what the battery's doing. It's well under construction. You might have seen from various photos that we've posted, and as you mentioned, we hit a major milestone in terms of GPS. So we all know how difficult GPS is in the ordinary course. In this case, we took through for the first time EKS, our inverter supplier, as part of the battery, which is being delivered by Powen. And so, it's obviously a key milestone to bring a new entrant to the market and bring that through the GPS process, which, as we all know, in Australia is very, very, very rigorous.
Let's just talk quickly. We've just got a couple more minutes with you before we move on to the next one. I just was interested in the tender that you won with the New South Wales government, because that's an interesting one. It's a 4-hour battery. So basically, the Waratah battery is really providing a grid service, and only a part of it's going to be sort of doing what people might conventionally think a battery does, which is store energy to use later. The 4-hour storage, I'd imagine, is very much on that storage and just sort of shifting, demand or shifting supply to where it's the demand. So how's that working, and how attractive is that, and how you? I mean, do you just see that the nature of these contracts being awarded by the New South Wales government as basically like a basic underwriting and a de-risking thing, which makes it easier to get finance, or does it still depend, and therefore does it still depend on contracts elsewhere with other customers? I'm not really too sure.
Yeah, no, it's good question. Probably all of the above, to be honest. But if we just break that down a little, so the Altessa, and of course we all know the SIS product, or the SISA that's being rolled out at the federal level, is heavily modelled on that. It's largely the same sort of structure. So it's really a revenue floor with an annuity top up, depending on the extent that wholesale prices or your wholesale revenue is below what you bid in as your strike price. So, I mean, we like that product. I think it's a smart policy from government to not distort the over-the-counter market in terms of offtake, but we see that product as really enhancing it, because what it's doing, particularly in 4 hours, is helping bridge at the moment a bit of a pricing gap. So we're seeing that the true value of 4-hour batteries, or 3+ hour batteries, isn't fully priced yet in the market, but that's moving pretty quickly. And so what this allows us to do is bridge that pricing gap. Obviously, we're looking at financing on top of that, and to your other point, it does also then allow you to layer on top other products, and that's what's great about it. It doesn't, it's very hard. The SIPS product has some restrictions around what you can do. We can have that 150 megs merchant, but it's difficult to layer other contracts on top of the SIPS because of the strict capacity requirements or being available. With the Altessa, it's actually designed, you look at those who design it, they're very clear in the objective, which is that it's to enhance the liquidity in that offtake market by allowing you to write other products on top. And so I think, certainly if you took a view that you were happy with merchant exposure beyond what the Altessa is doing, you wouldn't necessarily need to write other contracts on top. But as we know, I think in terms of bringing in debt and getting good pricing on debt, you do need additional contracting on top of that to get the banks comfortable.
Cool. Okay, Paul, we'll come back and tackle some of those questions later on. But look, I just thought right now it might be time to introduce Daniel Burrows from Acacia Energy. Daniel, thank you too for joining this webinar. Sam, if we can get Daniel's line up there so everyone can see him. And
Hey there, Giles. Maybe if I say something that might help with the
There
tech.
you go. You got to speak to be seen.
Yeah, there you go.
So Dan, you're the CEO of Acacia Energy. Now, Acacia Energy is a relatively new player as well. You've got important backers, the Macquarie Group, or you're part of the Macquarie Group. And you last year started off the Hazelwood battery, which was really interesting because it was the first big battery to be actually sort of commissioned and started operating on the side of a former coal plant. So it was kind of a bit of a landmark event in that point. So look, just tell us a little bit about Acacia Energy and tell us about Hazelwood and then some of your other plans, and then we can maybe have a deeper dive into some of those things.
Yeah, yeah, sure, Giles, and great to see you again. And I think we met huddled behind a marquee at the Hazelwood commissioning event. So great to see you
It was
again, and
bloody
likewise.
it was bloody cold and windy, if I
It was
remember. We were
very
both sort of
cold.
shivering, trying to record a podcast, but we managed to do it.
No, we got there. We got there. But no, great to see everybody, and thanks for having me on. And look, I head up the Asia Pacific operations for Acacia Energy, and one of my other responsibilities is as Chief Investment Officer of Acacia Energy. But great to be on and sort of share how we at Acacia Energy see value creation really out of energy storage, and that's how we think about it. So Acacia Energy is a technology-enabled global energy storage specialist. So we develop, build, and then actively manage energy storage assets for the long term. Currently, we have operations in the United Kingdom, Italy, Japan, and Australia. We have 48 projects in the pipeline across those geographies. We have 3 projects in construction in the UK, totaling just over 110 megawatt hours. And our first 40 megawatts will come online in the next couple of months. So we're pretty excited about that. Closer to home, if we go through our portfolio here, as we mentioned, and I'll come back on this one, Hazelwood, the Hazelwood battery energy storage system is now trading in the market. That's 150 megawatt hour system. And it was the first former coal-fired power station to be converted into an energy storage site. So we were pretty pleased with that investment and our partnership with Engie out there at Hazelwood. We have the Rangebank BESS. The Rangebank BESS is a 200 megawatt, 400 megawatt hour system. Again, that system is in Victoria. That's in partnership with Shell and Perfection Private. And what's really interesting on that project, that's supported by a 20-year offtake from Shell Energy. So again, the concepts of partnership, long-term contracting is a theme that really comes out in our business model. And the final project we're in late-stage development on and looking to reach financial close imminently on is the Canberra Big Battery. So that's a 250 megawatt, 500 megawatt hour system. That has been delivered in partnership with the ACT government. And the business case there is a 15-year revenue swap. So what we're doing with the government is we're exchanging half of the revenue that will come out of that system for a 15-year fixed annual payments escalating at CPI. So similar to what Paul was talking about around revenue stacking, different use cases, there's some themes that we see in the business as well. Now, for us, what we really look at is how are we creating infrastructure style assets and how do we create value at Acacia Energy and how do we think about value? First of all, it comes down to the people. We've got 70 fantastic people around the world that come into work every day thinking only about how do we create safe, secure, reliable energy storage systems that we genuinely believe will deliver the most cost-effective green energy to the end energy user. Now, that's really important in that the energy transition will be messy, there will be change, but we're confident if we're creating assets with that principle in mind, we're going to be creating good long-term community assets. The second part to that is we need to create those assets at an appropriate risk-return profile. And I've seen some staggering stats in the last couple of days. I think there's something like $4 trillion per annum that needs to be invested in the energy transition if globally we are to reach our objectives. Transmission, I think there's something like 50 million kilometres of transmission that needs to be built globally by 2040. So if you sort of step back and go, well, what does that mean for us all? And then what does that mean for energy storage? There's a huge capital requirement. So the cost of capital is going to be one of the biggest drivers of making sure we're genuinely delivering the cheapest energy prices in the market we operate in. So for us, what that means is we seek to create a risk reward that is compatible for infrastructure style investors. We think that will deliver the lowest cost of capital and ultimately the best pricing for energy users. So it's combining that infrastructure mindset with that purpose of delivering our energy storage assets, how we feel we create value at Ecu Energy. And there was a nod there, Giles. You mentioned Ecu Energy. While we're a new brand, we were stood up in November of 2022. The business was incubated within Macquarie's Green Investment Group for a number of years before the business was launched. We have Macquarie Asset Management as our majority shareholder, and then British Columbia Investment Management as a shareholder as well. So what we've really taken, I suppose, is that pedigree and that really keen focus on risk management and ensuring that the energy systems that we ultimately reach financial close on, we feel are compatible with that risk return profile. So that's sort of what we're up to at Ecu Energy.
Look, I thought I might just ask a quick question about Hazelwood then. So that's your first operating battery. How's that been going? How's it making money? And you've got a lot of capacity there at that Hazelwood site, and you've got potential to sort of make that a lot bigger. What sort of market developments need to occur, or should occur, or will occur for that to happen?
Yeah. So look, down at Hazelwood, the size of that connection point, I think, is about 1.6 gigawatts, and we've got 150 megawatts operational today. So there's plenty of capacity, and that's in the Latrobe Valley. Like that is the heart of, or the home of, the energy market in Victoria. So you benefit down there from just really strong transmission. So you can be there and your systems will be reliable. I think back on February 13, with all of the redundant paths back into Melbourne, as we sort of had some of the 500 kV lines go down, the system was able to operate and able to be there for the market. If we look at Hazelwood specifically, how does that work from a value perspective? What we've done is we've leveraged the existing electrical infrastructure at the former site of the Hazelwood Power Station. So that's enabled us to get some capital efficiencies. We've also designed that system so that it can be expanded. It can be expanded with the benefit of another revenue contract or without a revenue contract. So probably most interestingly at that asset, one of the new markets that has opened up is the fast frequency response market. And what we have seen in the market is value is probably more quickly shifting into energy and away from FCAS. And within the FCAS markets, the value is very much moving to those faster responding products. So the fast frequency response market rewards participants that can respond in under 1 second. Obviously, that's something batteries can do. Now, when we made the financial decision to invest in Hazelwood, that market didn't exist. It was one of the markets we thought would come into existence. And within the next couple of weeks, we should be registered for that market. So it's an example of different revenue products coming in that are rewarding energy storage systems for providing those valuable services to ensure the grid can operate safely and reliably.
Gradually unlocking the various bits of that Swiss Army knife. Just a very quick question on the battery that you've got a contract with Shell, 20 years. So do they basically, I mean, do you care what they do with it? I mean, they just basically provide you with some sort of, a lease or just an annual payment, and they can do with it whatever they want?
So that is a physical offtake. So Shell does have the right to trade that energy storage system. So it's not a derivative. And what we've done is we've partnered with Shell in the equity and along with Perfection Private, who owns the land on that site. And what we sort of did is we came together and said, look, how do we create a system that is suitable for Shell to offtake to help them manage their risk? Now, I obviously can't speak for Shell, but I think they're on the record for saying that this system is something that they will use to look to supply long-term green energy to their C&I customers. So what we did, we worked with the technology suppliers to make sure we had a system that was specified in a way that would help Shell meet their needs. And then we structured a contract with Shell on the offtake side, with Fluence as the technology provider in that instance. And what we did is we put that project together over a couple of years. It took time to get to financial close. But what we did is we put it together with the principles of project finance so that piece of infrastructure looks like any other piece of infrastructure. And what that enabled us to do is raise project finance debt against the energy storage system. which is a very low cost form of funding. And that was ultimately, we were ultimately able to do that and offer Shell a price that enabled them to write that 20-year contract.
Cool. Look, Dan, thank you very much. We'll come back to you and to Paul with the questions later on. But look, for a moment, for now, I'd just like to introduce Tim Buckley from Climate and Energy Finance. Tim, thank you for joining this webinar and for being online. And if my understanding is right, I think you're going to share a few slides and talk about some of the international developments. And I'm guessing possibly on price. Oh, good. There's me on the screen at the moment. That's a frightening thought. Tim, are you there? Speak to me.
Yes, sorry, Giles. Just trying to share the screen, and of course, as soon as I tried to do that, I lost the mute button. So
that's right. Okay. But welcome. Thanks for joining this webinar.
Thank you very much for having me. Now,
okay, I'm going to let you go. You just you better introduce yourself and then and run through your slides. And
is the slide come up or not?
Not yet. No.
Wait, I'm going to do it one more time. Otherwise, I'll drag.
You're going to have to talk about it. Just while we're fiddling around with that screen, just a reminder that you do have a question, please put it in the Q&A part. There is a chat thing there as well, but I think the Q&A is where we're going to go to find the questions. And it looks like we've got a slide or a screenshot.
Okay, so we're working.
Tim, it's all yours.
Okay, thanks. Can you hear me now?
Yes, I can.
Great. So, although I'm right. Thanks very much for having me. I'm just going to run through a couple of slides. Anyone who's seen me talk before, I know I love using slides and I love stealing from everyone else. So I'll acknowledge the sources here. A great chart from Bloomberg, but it picks up on the point that Daniel made about the world needs at least $4 trillion a year investment in clean tech. In fact, Bloomberg says the number is probably more like 5, 6, 7 trillion US dollars a year. Absolutely mind-blowing numbers. But last year, on Bloomberg's numbers, the IEA came up with the same sort of number, 1.8 trillion US dollars invested globally in clean tech last year, up 17% year on year. Now, what I'm also showing here is that batteries are the tiny bit in in pink, double the size of nuclear, but we won't go there. But what I really wanted to highlight here was it's the convergence of variable renewable energy and in the power markets and the electrification of transport that's really stimulating the technology development and the manufacturing scale in batteries. So 2 years from now, 3 years from now, the pink sector is going to be dramatically bigger. Now, this is a chart of Solon from Canadian Solar from their investor briefing. It's interesting, almost all of the big Chinese companies, and Canadian Solar, despite the name, is Chinese, are extending their expansion of manufacturing from wafer cells and solar modules into batteries. And so they're absolutely looking to see batteries and storage rolled out concurrently behind the meter. Now, this chart shows the dramatic growth that Wood Mackenzie is forecasting, 30% compound growth over the next decade. Absolutely pivotal, very much consistent with what we've seen in solar and wind over the last decade, or more solar in the last decade. And you'll see here, China is at least half, if not 60% of all installs last year, and expected to maintain a 50-60% share going forward, at least over the next decade. Everything we see in China absolutely supports that forecast. And this is the IEA analysis of capacity. So everyone's been saying, oh, we're all capacity constrained. The IEA stopped saying that last year because the battery manufacturing capacity expectations by 2030 in 1 year in the IEA's database grew tenfold. So all of a sudden, we've got more than enough batteries manufacturing capacity around the world in the investor pipeline coming through. And a lot of that's come through already in 2023, 2024. And yeah, as I mentioned, there's some stats about the Chinese National Energy Administration numbers. They installed 20 gigawatts, 43 gigawatt hours last year, 200% growth year on year, and expected to see another 50% growth this year. And of course, it's China. They'll generally outperform any forecast they actually put on the table when it comes to decarbonisation. Another chart just to support the data and the speed of change. We've heard about the first quarter slow or decline in sales at Tesla and BYD, year-on-year decline, yet total battery manufacturing capacity in the manufacturing production in the first 2 months of this year was up 27% year-on-year. And what this chart also shows is that 6 of the top 10 players are Chinese, with 61% global share in the first 2 months of this year. So they're gaining share, they're expanding capacity, they're investing in research and development more than any other country in the world. Korea is trying to keep track and keep up with the Chinese. That's a real battle. There's one Japanese company. America has seen a massive, like $50–100 billion invested in battery supply chains in the last 12 months, thanks to the US Inflation Reduction Act, but almost all of that is from Korea and Japan, and CATL is looking to get in there as well. They're negotiating with the Department of Energy for access to the US market.
Hey, Tim, can I just interrupt very briefly and ask you to click on Use Slideshow in PowerPoint? Apparently, you're just in presenter mode. There you go. That looks better.
Sorry, 2 screens. Thanks, Charles.
Off you go again. Off you go.
Okay, and I might get Sam to do a poll of the audience, but this chart just shows, like solar, we've seen a massive decline in battery costs over the last decade, last 14 years, a 14% decline last year. And so the question, it will be, what sort of level of decline will we see in BESS, battery energy storage systems, as opposed to cells and cell packs? Because obviously there's a lot of EPC involved in that. Now, engineering, procurement, construction, it's all everything other than the battery cell that still costs a lot of money. But rampant double-digit deflation in batteries is my forecast. We've seen solar prices in the last 12 months down, solar module prices down 50%. We're seeing double-digit decline in EV prices globally as well, on the back of much lower battery prices. And with the lithium price down more than 80%, the nickel price down 40% or more, that obviously is feeding into deflation. Rather good relief after a couple of years of fossil fuel hyperinflation. And again, another split just on from Bloomberg, but just highlighting how far China is. To me, China is response to the Inflation Reduction Act in the US has been to go twice as fast. China last year outspent the US by 100%, $676 billion in China in clean tech in 1 year, double what America did and double what Europe did in aggregate. So China, absolutely the world leader in manufacturing, but in installations, China installed 24 gigawatts of wind and solar every month last year. Solar installs in the first 2 months of this year are up 80% year on year in China. It's just staggering to see the speed of development of China in this area. A real strategic problem when it comes to supply chain management globally. The red is China, that's batteries and refining of critical minerals. China dominates all the value add refining, and that is causing massive, massive global tensions. Every day, the Financial Times is writing articles about either the EU or the US or both of them, criticizing China for dumping and for undermining the viability of industry in Europe and America. We are seeing the breakdown of world trade because of the national security geopolitical landscape, but China absolutely dominates when it comes to manufacturing cost and scale and technology. So it's going to be very, very hard to see that break. My recommendation for Australia is not to compete with China, but to partner with them. And then maybe the second last slide. Paul mentioned the massive uptake in battery energy storage system is in response to the massive rise in variable renewable energy. This is the IEA, the International Energy Agency's forecast for demand growth in electricity in China, supply of electricity growth in China by fuel type. And so the green is variable renewable energy. That has to be managed and BESS, battery energy storage system, and pumped hydro storage in China. China's doing both of them. China's doing about 10 gigawatts a year or more of new pumped hydro storage every year this decade. And as I mentioned, they're doing 20 gigawatts, 30 gigawatts a year of battery energy storage system. And they're spending $80 billion a year on grid modernization and expansion. But you have to do that to manage the intermittency of low cost, zero emissions, domestic renewables. Last slide, and I'll stop there. But I actually stopped tracking this. I've been doing a lot of work on the need that Giles touched on about the closure of Eraring. And this chart was some of the data I used when I was writing the lights will stay on if we close Eraring. There is so many new battery energy storage system proposals across New South Wales, let alone across the whole of Australia. I stopped counting when I got to 13 gigawatts, 38 gigawatt hours of battery energy system proposals in New South Wales alone. There's absolutely no shortage of proposals. We have a planning roadblock as the core problem, so that needs to be solved. And on that, I will stop there and go back to you, Giles.
Oh, thank you very much, Tim. And look, maybe we can have all the panelists on show now, because we're going to go to questions. The first one, and I feel a bit obliged about this, is from Jeff Little about how do you see flow batteries as grid support option to Li-ion batteries. I'd like to sort of broaden that out and just ask whether the maybe starting with Paul and then going to Daniel about do you have any particular view on flow batteries? But what do you see as the big competition for lithium-ion batteries? Just in general, I mean, it could be gas peakers, it could be pumped hydro. You know, when you're sort of viewing the competitive landscape going forward, what do you see?
Yeah, look, I mean, we're technology agnostic as a business. I think anyone doing battery development probably needs to be, in terms of keeping an eye on changes in technology. I think the challenge with flow is just proving the scaling of that as a commercialized technology and the right price point. Obviously, there's a benefit in flow in terms of longer duration, and then of course that's a big focus in terms of how many, you know, both number of hours and sort of seasonal storage around the role of different technologies. So we are agnostic. Having said that, you know, I think it's, you know, the batteries we're all doing, I'm sure it's the same for Dan, are all lithium-ion LFP technology, which I guess at the moment has proven itself to be the most scalable, and in terms of actual benefits from a price point of view, also in terms of safety, you know, in terms of withstanding fire and heat and those sorts of points. So there's a lot of benefits that go. I think we look at the production lines that have been created, you know, the additional capacity that's particularly in China, amongst most countries where most of the cell production is happening, and that's the technology that's been locked in. So that is locked in for many years, even as other technologies come through. So I think we will still see the dominance of that. I couldn't see on my screen what the response to that poll was actually, Tim, in terms of the.
Yeah, let's get. There it is, back up here. Yes, 42%.
Okay, so I think 10 to 20%. Yes. Reduction. Yeah. So, and that, I think that probably reflects exactly what Tim was alluding to. If you look at the history of particularly solar, it's that economies of scale that we just see pricing come down, particularly when China's doing that. So I think, yeah, at the moment that's the technology we're focused on. We see that as you know, the most applicable in terms of meeting our timescales and the size of projects.
Are you actually seeing those prices reflecting when you're going out to tender and seeing suppliers? I mean, I know Jeff Dimery from Melinta, he's speaking as, you know, don't want anyone to sort of move over to the National Press Club, but he's talking to the National Press Club at the moment and saying batteries cost more now than what they did, you know, 1 or 2 years ago. So what are you seeing out there? Those cost reductions flowing through? Yeah,
I'd like to say we're getting the full 20% on our pricing that we're negotiating at the moment. Probably not the case. I think like a lot of that movement we've seen in terms of lithium carbonate and the changes in that, which obviously is a key price input to final pricing. There are others as well. But yeah, I think you've got to balance that with just the other side of the equation, which is what Tim showed in terms of the demand. And I think some of the questions just scrolling through here, which I'm sure we'll get to, is people sort of asking, when is there a saturation point, right? When is it that we've got too many batteries. But I think at the moment we're still a long way from that. I'm happy to sort of dive into that as a follow-on question.
Yeah, sure. Daniel, what are you seeing in terms of prices? You're got a bunch of projects out there. You're getting better offers from the suppliers?
I think you've got to break it down into the component parts in looking at the cost. I think those numbers are probably broadly right if you're looking at lithium-ion sort of battery cell packs, and once you factor in the commodity price reduction. What we're seeing more in the market is probably tightness in supply chains around high voltage transformers, around inverters. So that's where we're seeing some of the pressure. I think some of the features we're seeing is we're having to take much more significant early works, so invest more capital ahead of making an FID to preserve schedule and preserve time. So that's probably a key feature we're seeing. So on the balance of plant side, there is just a competition for labour and services where there's sort of that upward inflationary pressure, and that is being significantly offset by massive economies of scale coming through just on the battery lines. So we're really seeing sort of two different dynamics coupled with supply chain shortages and longer lead times, which just requires us to be more nimble and react on a project by project basis.
Yeah, and Daniel, while you're there, there's a couple of questions there about the FCAS markets. You alluded in your introductory remarks that that probably the FCAS is it was once a sort of it was the first big sort of cream on the cake, but that sort of the cake it's not quite that big. But you're interested in the very fast frequency market. I mean, any sort of indications as to obviously FCAS is not going to be the big thing going forward, but how much of the revenue might come from the very fast market?
Yeah, I think it's almost, you look at the UK market and what happened in the UK market, they experienced the same dynamic where the value of the ancillary services markets came down as you saw more systems come online. So I don't think that's a surprise to anyone that follows the market. What we do see are more and different products coming out that will reward battery storage systems. And I think one of the things we really look at on any system that we FID is we're underwriting to multiple different revenue products that we're highly confident that we should expect we can contract to over time. And it's one of the great things with an energy storage system in that it's constantly co-optimizing. If value is shifting from one of the markets, you can shift your capacity into other markets as well. So the trend we've seen is probably more value in energy than we had actually anticipated. And what we've actually seen with the bidding software and the bidding strategies at Hazelwood is the prevalence of negative pricing has probably supported that value in energy above and beyond what we were expecting. So the value moves around depending on what's happening in the market. And I think that's one of the great things about batteries, that they can provide so many different services and you can actually be co-optimizing within 5 minutes and respond in sort of sub-second time. So I think that's where storage has that.
Yeah, maybe Giles, just to add on to that, and I was looking at a few of the questions, there was a couple of questions there around some of the nature of some of those products, particularly like from corporates, as well as sort of, I guess that to what extent is it going to shift away in terms of the value? Is it more FCAS, more energy arbitrage, etc.? But just to add on Dan's point, I think what we've seen, we've already seen a pretty quick sophistication in the offtake market in terms of what off-takers are looking for. And I think, a physical toll has been sort of the product of choice when you look back to the last couple of years in the Australian market and elsewhere. But I think we're seeing a shift, at least here, in terms of products that give the off-takers, whether they be retailers or corporates, more flexibility around how that battery is used, all the way to sort of virtual products, and then sort of managing issues around lease accounting and things like that. So I think that value proposition also means that if you have those products, as Dan says, as a battery owner operator, you can optimize the battery in terms of pursuing certain revenues, even where the forward market's not necessarily valuing some of that. So what we're seeing, for example, is that most off-takers don't perhaps value FCAS as much as the energy shifting. And so products that allow you to actually contract the energy only separate to how we optimize the battery in the physical market really sort of, I think that's the next, the next space here is we get that more sophistication in the market. Of course, when you have capacity markets like in the UK or California and others, it's you've got to structure those quite differently because of the nature of those types of markets.
Yeah. Hey, Paul, while you're there's a couple of questions, specific questions about the Waratah battery. One is how they don't say how the heck, but they do ask how did you get a grid connection process de-risked so quickly, considering that EKS, your inverter supplier, is a new market entrant? And there's another one just asking about the level of accuracy from the batteries, and I guess it's just probably a possibility to sort of talk about the speed and accuracy and versatility of battery storage to people. So
yeah. And there's probably better people in the Acacia team who can get into technical side on this. But the shorter on that first question on the GPS, well, I mean, a lot of work went into that. Is probably the short answer. That did require a heavy lift to get AEMO comfortable with all the modelling in respect of EKS as a new market participant. So I wouldn't say there was any. It was just a lot of heavy work and a lot of going back and forth with AEMO, working pretty collaboratively.
All parties were very motivated to come to a mutual agreement outcome, and yes, and I know how sensitive it is. We actually wrote about the just one line in a story the other week about the Capital battery, which has been delayed because I think there's been problems about that. And within an hour of our story being published, it had gone from the minister's office to the market operator to the developer, back to the contractor, and back to us. And there's a lot of sensitivity about that. But anyway,
so there was a lot of work, and look, we think we're really excited about that. Very happy. We got there, of course, for many reasons, but one as well, I think it's really important that we have more players in the market, more competition for those entering. So it's good to see that we could get EKS as a new market entrant over a very high barrier. We all know that GPS requirements in Australia are some of the toughest in the world. So that was great. On the second question, probably can't go into a lot of detail on the specifics of that, but I guess it's fair to say that what we have to deliver by way of technical specs, as far as SIPs are concerned, is very strict and is extremely specific. It's not something that you can sort of say just deliver it in a general way. There are very specific requirements. So that does mean we've had to design and configure the battery in a way and agree an operating protocol that delivers exactly what Transgrid needs as far as that response of the SIP service.
Yeah, but we've got a lot of questions about things that mean sort of future products and sort of revenue things, which is sort of, I guess, the purpose of this webinar. Some of them specifically relate to the CIS, the Capacity Investment Scheme, which is the federal government's thing, 6 gigawatts coming up. I wonder, Tim, we can just bring you in here. Have you any sort of thoughts about whether the CIS is going to sort of deliver what it is supposed to be delivering? And does that remain the main driver of battery investment in Australia? And then maybe we can turn back very quickly to Paul and Dan. And because we are getting towards the end of the webinar, let's make our answers as succinct as possible. Tim?
Thanks, Giles. I'm very hopeful about the capacity investment scheme. I'll be quoting your own research media. It's research here. You're suggesting the first one will be 6 gigawatts now out of 32 gigs, which means they'll then step down to 3 gigs just mathematically per 6 months thereafter to get it all done within 4 years. But we need to see the results. But certainly talking to the Energy Minister's office in the last couple of weeks, the small 600 megawatt, I think it was, South Australia and Victoria tender, which is the precursor to the CIS, was massively oversubscribed. And my response is, therefore, upscale it. If you've got a whole lot of great offers, upscale it, because we need as much capacity as we can get in the system as soon as possible. And I like the fact that the federal government is de-risking a lot of the projects. We then need the states to actually start approving projects so they can actually then be built. But I'm very hopeful that capacity investment scheme will play a major role in de-risking and crowding in capital. We have to get our $3.6 trillion superannuation industry moving at scale to replicate what the likes of Macquarie and BlackRock are doing.
Then any thoughts about the CIS and how that might facilitate more battery storage developments? I mean, is that going to be a key part of it and a useful platform to get other contracts? How are you seeing it?
Yeah, definitely. Most definitely. We really like the product. I think, it basically, as I said, allows us to revenue stack in a way with different products. I think that it's really going to innovate the market, and as I see it, really crowd in the ability to write other contracts with different types of off-takers. A couple of questions have come in on the corporates, maybe just sort of related to CIS. I think it also does help in that market. So what we've seen is a real shift from, I guess the challenge for corporates, they've all signed up to renewables targets. They went out and procured renewables. They're now looking for a way to firm that product or to firm that generation. And I think, looking at the way batteries can financially firm that, as opposed to an actual, following the load profile and the generation profile, is where we see corporates moving. And I think once we see that happening, the CIS is going to be a good platform to be writing additional corporate offtakes in that space as well.
Yeah, Daniel.
Yeah, I'll be quick, Giles. I think the intent is right. I think to support and work with the market. I'll make more of a comparative comment. In all the markets we're operating in, there are capacity contracts and products that are being bid, and I think one of the key features is the thoughtfulness of the design around D-rate and how you pick a duration. And I think the direction I see it going in is actually just making sure we get the best deal for the taxpayer, or we're delivering the lowest cost energy prices. So when you look at capacity, you want to make sure you're stimulating investment in the right product at the right time. So when capital costs are at the right time, when debt costs are at the right at different pricing, different durations are going to be more economic. So I think one of the key features of the design is making sure it has a level of simplicity, but it provides a level of price discovery, and the taxpayer or the end energy customer is actually getting the best deal. So I think that needs to be the overriding principle, and that's sort of what I'm hearing in the conversations we're involved in.
Yeah. Okay. Just another question. This is about sort of Queensland, about tariff structures. The sort of the costs that battery storage facilities have to pay to networks. Is that an issue? Someone specifically referring to Queensland here about $6,000 plus annual cost for a daily charge, and I have heard sort of broadly that tariff costs, maybe the networks are getting a bit greedy, but.
I mean, maybe can't comment on the dollar amount, but I think, I guess, there's always a challenge as a developer in terms of getting getting your connections signed up in a way that you can manage those costs. I'm not sure I wouldn't say it's just Queensland. I'm not sure if there's any specific there, but certainly we've been dealing with the various network operators there as well as other states. So I think price certainty, you're getting that locked in as we sort of move through final investment decisions and financial close. That's really the key thing. And to the earlier point about GPS connection, just getting through that whole process, it does take a long time. And I'd echo Dan's point that part of the challenge is you do have to do a lot of early procurement, and some of those putting in place early works, early procurement, particularly on the BOP side, to keep scheduling in place as you sort of closing out all of those connection arrangements. So I think generally, whether it's battery developers or renewables, accelerating this sort of process and speed around getting your connection in place is a key focus of everyone. And I guess there's been discussions about how that can be improved.
Daniel, maybe one here for you. Tim's asking, Tim Ryan is asking, is any battery storage operators looking at energy storage as a service, ESAS, where customers, businesses, including variable renewable generators, can book storage and discharge and pay kilowatt hours, megawatt hours round trip fee? I guess that's probably a bit like your Shell contract, but rather than sort of one customer for the whole battery, you sort of got multiple customers for something. Is that something that's or is that hard?
Well, it sounds like someone's been listening into the chat around the lunch table in our office. But I think like financial innovation drives a lot of the things that we do, and what we try to do is get value to whoever values it the most and whoever will pay the most for it, and then stack that value up. So I think one of the key features you'll see is energy storage systems will get larger, they will get more complex, and you're often seeing multiple grid connections at the same location, which allows you to contract and give control of dispatch to more than one party at one physical location. So you can create virtual products, and we're spending a fair bit of time around that. There's also physically ways you can compartmentalize an energy storage asset. So whether it is as a service or the name that ultimately comes up for it, we really focus on partnering and what do people want and how do we get them what they value the most, and whether that is physically or contractually through a derivative. So it wouldn't surprise me if it happens, but I'm not sure. I'm not sure you'll be parceling out individual cells in the next 12 months.
No, that's okay. Look, we've just got a couple more questions to go before we wrap up. Look, there's so many good questions here. We could probably go for another couple of hours, but of course we don't have the time to do that. Look, just back to you, Paul, and then I'm going to come to Tim with another question. But Paul, there's a couple of questions here about recycling, and look, it isn't. We are talking about circular economies. We're trying to do this sort of properly. So when you guys are thinking about sort of big storage, I mean, how are you thinking about what happens at the end of the product, or is it just too far away, 20, 25 years, I'd imagine? But to what extent are you thinking about that now?
Yeah, no, we definitely think about it. I think it's I think in terms of actual recycling systems that will sort of cater for that, I think that's still a lot to be done in that space. I think we're still seeing it catch up with the solar industry. I mean, it's not just batteries, but you look at the end of life of some of those areas and sort of systems catching up. But we do look at it certainly in terms of making sure we understand what our suppliers in the supply chain, how they manage that as part of the provision or also the supply of the battery to us. So I think we've seen some of the early, and I guess we've seen some regulatory moves, particularly in Europe, around mandating requirements around that. I'm sure Australia will follow suit not too long after that. But no, we definitely look at it to make sure that from a supplier point of view, we understand how that's going to be done at the end of the life. And I guess there was a question there as well, which probably relates to that in the chat around sort of life of these batteries and sort of repowering. And I guess that's also one of the things we look at is what's the, most projects are looking at 20 years. You're getting performance guarantees on the cells up to 20 years. But it's also looking at what point does it make sense to repower those assets. And then, of course, a key consideration at that point is, how do you recycle those and the value chain and the systems for that.
Okay, we might have time for one more question. This is going to go to Tim. Look, I'm just going to give a plug to the sponsors of this podcast, which is Energy Storage Australia. They're having a conference in Sydney, May 21st to 22nd, and early bird pricing finishes on April 26th. So you can find that on your registration page, or just sort of Google Energy Storage Australia. Tim, there's a couple of questions here about Australian manufacturing. Most battery storage systems, or all battery storage systems, are coming sort of from overseas, apart from some domestic batteries. You mentioned before about collaboration with China. We've seen some initiatives from the Bowen government about a solar manufacturing facility. That seems to be a bit more about sovereignty than being sort of price competitive. Where and how should we be going on this?
Yeah, a short answer is it's a strategic issue for our military. Absolutely. I have actually done some presentations to them, and they've highlighted the massively lower thermal footprint of an EV versus a diesel fuel truck, for example. So they can see the massive benefit of EVs, but as the questions in the chat have alluded to, if the batteries are imported from foreign powers that we might then end up at war with, or America ends up at war with, that's a strategic problem. But the military doesn't buy a lot of batteries. 99% of them will be imported. I'd also emphasize we could do assembly in Australia, and we can do the IT componentry. People like Fluence are able to do that, not to promote a particular company, but batteries are a whole supply chain. We do the lithium, we could do lithium hydroxide. We are doing it. We could do the cathodes and the anodes. We don't have to do the whole supply chain, but we do need to think about national security, and we need to build some capacity so that when I put up a chart showing the absolute total dominance of China in every sector in the zero emissions energy transition, that is a serious geopolitical problem. It can't be solved by private finance. It's got to be solved by government involvement and by things like the Quad.
Okay. Hey, just one final question for each of you, starting off with Tim. Are we going to get to 82% renewable by 2030, or are we just going to get close enough?
Ask me in 6 months' time, once the first capacity investment scheme's out. That'll be a critical enabler to encourage people to realise and then rinse and repeat every 6 months. I want the government to upscale it. So let's see how many tenders Minister Bowen gets in his first SIS. I think he'll be pleasantly surprised. I'm still confident, but we do need New South Wales to pull their finger out. Without New South Wales, we can't get there.
Okay, Daniel, it's more of a political sort of policy decision. I know you probably don't really want to go there, but I mean, I guess it's just one sort of, you know, you're sort of confident in this energy transition, or you worry about it.
I think for us, the dialogue we're having internationally and locally is encouraging, and all of our projects are bottom up. Each has their own specific story, their own specific use case, and I think what the transition requires is a whole bunch of great businesses doing their piece to make it come together. So while we keep an eye on the policy side and we contribute where we can, with that view to delivering the lowest price energy where we operate, we really take that bottom up approach where every project is different, and we work with partners and governments on all of them.
Yeah, Paul, are you bottom up or top down?
Well, I would agree with Tim. I think we're going to get close. It's a big task, we know. I think the SIS is a great product to help get us there, and I think for our part in it as a battery developer and owner operator, I mean, key to that 82% is having the storage that goes with it. So we like that, and we're going to be very keenly involved in it. And I think it's that scale. That's why, you know, we as a business really focusing on large batteries, because we think that's where you get the efficiencies and the scale, and that's always going to be key to supporting that 82%.
Look, we're going to have to sort of wrap it up here. Look, thank you very much to everyone for joining. Paul Curnow from Acacia Energy, Tim from Acacia Energy, and Daniel Burrows from Acacia Energy, and Tim Buckley from Climate and Energy Finance. It's been great. Look, thanks for everyone for joining. We had more than 500 people here on the screen. It was absolutely fantastic. Sorry we couldn't get to all the questions. Apologies for our lack of gender diversity. We'll try and do better next time. And also, I'd like to make my acknowledgements to the First Peoples of where I am, which is the Arakwal people of the Bundjalung Nation, and pay my respect to their elders past, present and future. Thank again to the sponsors, the Energy Storage Conference in Sydney in May. And thanks everyone for joining. Bye for now.
Thanks, Charles.